Imagine waking up a year from now and seeing that your portfolio didn't just go up, it doubled. Not because of luck or a flash of market hype, but because you invested in companies whose real business foundations were strong, whose numbers whispered value while the crowd chased noise. That's what separates the winners from the rest, and today I'm walking you through those signals. When you dig into a stock's financials, the first thing to examine is how the market values today's earnings, the price-to-earnings ratio P/E. That number shows how many years of current profit you are paying for. A low or fair P/E, especially compared to peers, tells you you're not overpaying for what the company earns now. Forbes +2 happy. Trade +2, but P/E alone can mislead. What matters more is what lies ahead. That's why you then step into the PG ratio, where P/E is adjusted for expected earnings growth. A company with solid growth potential but reasonable PG suggests you're paying sensibly for future earnings, a powerful way to sniff out value and growth together. Wikipedia +1, however, earnings numbers sometimes lie or fluctuate. So you also want to check how a company performs in generating real cash and how stable its business is at deeper level. That's where pricing, sales P/S and price to cash flow P/CF come in. When profits are volatile or companies are investing heavily, these metrics offer a clearer view. A low P/S or P/CF may indicate cheaper price relative to sales or actual cash the company brings in, a sign of real operational strength. Encyclopedia Britannica +2, Wikipedia +2, but value or cash alone doesn't guarantee greatness. You need quality. That's why you look at return on equity (ROE), how efficiently the company uses shareholder capital to generate profit. A company delivering high or improving ROE suggests that management is capital efficient, turning equity into real returns. Forbes +2, medium +2 combine that with reasonable debt, low leverage, and consistent profit margins, and you have a business that isn't just growing, but doing so sustainably and prudently. When you prioritize companies that check most or all of these boxes: fair valuation, growth potential, healthy cash flow or sales, efficient use of capital, and financial health, you begin to see the difference between stocks that scream hype and those that steadily build value. That's how smart money thinks, not chasing the next hot tip, but uncovering durable value before the crowd wakes up. The market is full of noise headlines shouting about hot stocks or the next big thing, but the real winners often hide in plain sight. Great stocks don't announce themselves. They quietly accumulate value, driven by real business fundamentals, and smart investors know how to spot them before the crowd catches on. If you want to identify companies that can compound wealth over time, there are key signals that reveal their strength. The first sign is consistent and sustainable growth. Look beyond quarterly hype or one-off earnings surprises. A great company consistently expands revenue, market share, or profits over multiple years. Growth that comes from innovation, operational efficiency, or capturing new markets is far more meaningful than growth fueled by short-term cost, cutting, or debt-driven expansion. A stock that shows a clear pattern of increasing sales and profit margins signals that the underlying business model works and that management knows how to execute strategically. The second sign is strong cash flow. Earnings are important, but cash is king. Profitable companies can sometimes report accounting profits that mask real financial stress, whereas cash flow shows whether the company generates liquidity to fund operations, pay down debt, or invest in growth. Price to cash flow ratios and free cash flow trends are excellent indicators. A business that consistently generates strong cash can survive economic downturns, fund innovation, and return value to shareholders, qualities that make a stock great. The third sign is financial efficiency and quality management. Metrics like return on equity (ROE), profit margins, and debt to equity ratios reveal how effectively a company uses its capital and manages risk. High ROE over time indicates that the company turns shareholder investments into real profit. Healthy margins demonstrate operational strength and pricing power, while manageable debt ensures resilience during market stress. Companies that excel in these areas tend to outperform competitors because they balance growth with discipline and avoid overextending themselves financially. The fourth sign is reasonable valuation relative to potential. Even the best business can be a poor investment if the price is too high. Look at priced to earnings P/E, price to sales P/S, and the PG ratio, which accounts for expected earnings growth. These metrics help investors determine whether a stock's current price reflects its true growth potential. A stock with solid fundamentals but undervalued relative to its future earnings trajectory is often primed for significant gains as the market catches up to reality. Conversely, a stock priced for perfection may falter if growth slows even slightly. The most successful investors do not rely on a single metric. They consider a combination of these signals: growth, cash flow, efficiency, and valuation to build a holistic picture. They recognize that a great stock demonstrates consistency across multiple dimensions, not just in one isolated statistic. By focusing on these indicators, investors can separate fleeting market excitement from durable value. The key is patience and disciplined analysis, looking past the hype to identify businesses that have the structural strength to grow, adapt, and reward shareholders over time. Stocks that tick these boxes are rarely the loudest on the trading floor or the ones trending on social media. They quietly compound value, often unnoticed until the market realizes what has been there all along. Recognizing these signs early gives investors the advantage of entering before broader attention drives prices higher, creating opportunities for long-term wealth accumulation. In essence, great stocks speak in numbers, not headlines. They reward those who read their signals carefully, who value real business performance over speculation, and who understand that the market's true winners are built on fundamentals that endure. The stock market is often loud, filled with hype and headlines promising the next big thing. But real wealth is built by those who see what the crowd overlooks. Winning stocks rarely announce themselves. They don't rely on trends or viral attention. They quietly compound value, driven by solid fundamentals that only careful analysis can reveal. If you want to identify companies that can grow wealth consistently, you need to understand the indicators the market often ignores. The first indicator is consistent revenue and earnings growth. Great companies don't rely on luck or one-off successes. They expand sales year after year, improve profit margins, and capture increasing market share. Growth fueled by innovation, customer loyalty, or operational efficiency is far more sustainable than growth driven by financial engineering or short-term hype. A company that can repeatedly turn strategy into measurable results demonstrates resilience and the ability to scale, which are essential traits for long-term winners. The second indicator is strong cash flow generation. Profits on a balance sheet can sometimes be misleading due to accounting practices, but cash flow tells the real story of a company's health. Free cash flow, the money a business produces after covering operating costs and capital expenditures, is crucial. It shows whether the company can fund its growth, invest in innovation, pay down debt, and reward shareholders. Stocks that maintain consistent cash flow, even during challenging times, indicate businesses with solid operational foundations and the ability to thrive in both growth and downturn cycles. The third indicator is financial efficiency and operational quality. Metrics such as return on equity ROE, profit margins, and manageable debt levels are powerful signals. High ROE indicates that a company turns shareholder capital into profit efficiently, while stable or improving margins show control over costs and pricing power. Healthy debt levels mean the company isn't over-leveraged and can weather economic stress. Businesses that excel in these areas are disciplined and able to grow without risking financial stability, which positions them for consistent long-term performance. The fourth indicator is valuation relative to potential. Even a perfect business can be a poor investment if its stock price is too high. Price to earnings P/E, price to sales P/S, and the PG ratio, which adjusts P/E for expected growth, help investors determine whether a stock is priced fairly compared to its prospects. A company with solid fundamentals that trades at a reasonable price has significant upside potential, while one priced for perfection carries risk if growth slows. Evaluating valuation in the context of future earnings and cash flow separates smart investments from speculative bets. The market often overlooks these signals because investors are distracted by noise, quarterly headlines, viral hype, and short-term momentum. But the most successful investors look beneath the surface. They focus on the combination of growth, cash flow, efficiency, and valuation to assess a company's true potential. No single metric can define a winner. Greatness emerges from consistent performance across multiple dimensions. Identifying winning stocks requires patience, discipline, and a willingness to challenge market assumptions. Those who master these indicators gain an edge, entering positions before the broader market realizes the value that has been quietly building. Over time, this approach rewards investors with stocks that not only grow in price but also generate lasting wealth through real, sustainable business performance. Ultimately, the market rewards those who read the signals the crowd ignores. The companies that survive, adapt, and expand will always outperform those chasing fleeting trends. The key to finding winners is not following hype, it is understanding the fundamentals that make a company exceptional, even when the market fails to notice. The stock market can feel overwhelming. Headlines scream about the next big thing. Social media celebrates instant winners, and everyone seems to have an opinion. But real wealth is built not by following the crowd, but by identifying companies that have the fundamentals to thrive over years, even decades. If you want to separate fleeting hype from durable growth, there are 4 proven indicators that can guide you toward successful investments. The first indicator is sustainable revenue and earnings growth. Great companies don't rely on a single product or momentary market trend. They consistently expand sales, increase profit margins, and capture more market share over time. Growth that comes from innovation, strong customer loyalty, and operational efficiency is far more durable than growth driven by debt or one-time market anomalies. By tracking a company's performance over multiple years, you can see whether management is capable of executing a strategy that turns potential into measurable results, which is the hallmark of long-term winners. The second indicator is strong cash flow generation. Profits reported on an income statement can sometimes be misleading due to accounting adjustments or short-term fluctuations. Cash, however, tells the real story of a company's health. Free cash flow, the money a business generates after covering operating costs and capital expenditures, reflects its ability to fund growth, pay down debt, and reward shareholders. Companies with consistent and growing cash flow are more resilient, better positioned to weather economic downturns, and capable of investing in future opportunities, which makes them far more attractive as long-term investments. The third indicator is financial efficiency and management quality. Metrics such as return on equity (ROE), profit margins, and debt-equity ratios reveal how well a company utilizes its resources. High ROE indicates that a company efficiently converts shareholder capital into profits. Healthy profit margins suggest operational strength and pricing power, while manageable debt ensures the company is not overleveraged and can withstand market volatility. Companies that excel in these areas are disciplined, able to execute growth strategies effectively, and maintain financial stability even during challenging periods, giving investors confidence in their long long-term prospects. The fourth indicator is valuation relative to potential. Even the best company can be a poor investment if its stock price is too high. Using metrics such as price to earnings P/E, price to sales P/S, and the PG ratio, which adjusts valuation for expected growth, helps determine if a stock is reasonably priced compared to its future earnings trajectory. Companies with solid fundamentals trading at reasonable valuations provide the potential for strong upside as the market recognizes their value. Conversely, overvalued stocks may falter if growth slows or expectations are not met. Evaluating both the quality of the business and its price ensures you're not overpaying for performance. Successful investing requires a holistic approach. No single metric can determine whether a stock is a winner. The combination of consistent growth, strong cash flow, operational efficiency, and fair valuation paints a complete picture of a company's long-term potential. The market often focuses on short-term excitement, but disciplined investors recognize that true wealth is built by analyzing fundamentals that endure. By focusing on these four indicators, investors can separate speculation from sustainable opportunity. The companies that meet these criteria are rarely the ones dominating headlines, but over time, they deliver compounding returns that exceed the hype. Recognizing these signals before the market catches on gives you a distinct advantage, allowing you to invest with confidence, patience, and the knowledge that your choices are rooted in real business strength rather than temporary market sentiment. In the end, the difference between successful investors and those who chase fleeting trends lies in their ability to read the fundamentals the market ignores. The stocks that consistently grow, generate cash, operate efficiently, and trade at reasonable valuations are the ones that ultimately create lasting wealth.